This is Metropole Television, but most certainly business. I am your just in time for your economic review this morning. My name is Simba Elijah Charles Kenya. You can talk to us at Metropole TV KE across all your social media platforms on YouTube. Metropole TV Kenya. Let me introduce the panel that is going to take us through the conversation in the next couple minutes. We're joined by Anne Mashara, who is an investment analyst. Anne, how are you doing?
I'm fine, thank you. How are you?
Fine, thank you. We're happy to have you around. We do expect Odhiambo Wamogi to join us as soon. He's an economic analyst and the CEO Elema Capital. But we do have in the house as well Chacha Bichanga, who's a financial literacy coach. Chacha, how are you doing, sir?
Fine, thank you. Good morning.
Good morning. Happy to see you around. All right, let's get into that conversation this morning. Richie, as you get ready with the bites. Now, the uptake of the digital credit services in the country is on an upward trend, with majority of borrowers coming from the rural areas. However, despite the growth, the full potential of the sector still remains untapped, as a significant number of Kenyans do not use the platforms. According to the latest survey done by the Real Analytics on 1,000 respondents across 8 counties, 24% of Kenyans are unaware of the services offered by digital lenders. However, a majority of 55% use the digital lending platforms, with 66% of them coming from an urban population. Experts have however warned that regulating the sector like banks might slow its growth, given majority of the lenders are non-deposit entities. Let's listen in, and then after that, come talk about that story this morning.
So one of the major highlights of this report is that 55% of Kenyans are taking digital loans from the digital lending platforms. Another significant highlight was that 66% of the urban population is taking digital loans, as compared to 44% of the rural population. But in terms of real numbers, the rural population actually has a higher absolute number of people taking these digital loans. We also found, interestingly, that the vast majority of people using digital lending platforms do not have a problem with the service fees charged by these platforms, or what you call the interest rates. We found that the issues that they express as causing dissatisfaction are mostly the length of time to repay the loan and the loan limit.
If you are to impose on them these minimum liquidity requirements or minimum capital to risk-weighted asset ratios, you really are punishing them for something that they are not doing. You're treating them like banks or SACCOs when in fact they are not. The resultant effect of this is you are then stifling the growth of this industry, because they do not have these minimum requirements, which is why they're able to move at scale, develop products much faster, and they also use non-traditional sources of information to rate your credibility. Imposing these requirements will then literally be putting them at placing the same burden on them as traditional banks, but without giving them the benefit of having had the experience that these other institutions have had. That's
it. So they're saying, out of that research, the only problems that majority of those on the platforms have, it is that they do not have a problem with the interest rates that are charged on these products. The only problem that they have is the length of time and the loan limits awarded to these products. Let me start with you, Anne. Question being, will regulating this industry affect the growth of digital lending in the country? Because you're going to hear that is the concern from those analysts.
I believe it will. As much as I support regulating the sector,
yes,
it will indeed impede the growth of the sector. You see, their major source of revenue is the interest they charge, and they do charge a high interest to their borrowers. But when we regulate it, let's take a case for banks. Banks can only lend at a certain percent above the central bank rate. If that is also trickled down to the digital lending platforms, maybe let's say right now there's CBR is at 7%. If regulating tells them you can only lend plus, let's say 5%, you see they'll only lend at around 13%, and for now, if you default, it's maybe like above that 13%. So they will not grow as much because most people will either now go to banks because it's kind of cheaper. And also, if you see from the regulations, they'll have to have minimum requirements, they'll have to be licensed, they'll have to have directors. And you see for this, as the report indicates, most of these don't have the minimal requirements, let's say 5 million to start a business, etc. So you'll see most of them just grow slowly as they will not meet the requirement from the regulations. Yeah, and also as you see for Mshwari, from the report, it had 40%, and this is mainly due to the backing of Safaricom. Tala and all the others, they were just lagging behind. So you see, without this backing from major entities, regulating them and telling them you have to have minimum requirements of, let's say, 1 million, you have to have 2 directors, you have to have all those charges. We'll see digital lending platforms just grow slowly as before the regulation.
Pretty much. All right, let me bring in Chacha as well. Chacha, we look at that 55% of Kenyans actually take those digital loans, and 66% of this population is from the urban setups in the country. What do those numbers point to, Chacha?
Okay, thank you. What I would say that those numbers point to the fact that a majority of the people who take these digital loans are in urban centers. That actually brings out the issue of awareness.
Yes.
But I would want to say that majority of the people, especially in the rural areas, may be aware of these digital money lenders, but they have other alternative sources of getting funds. Remember, in the rural areas, we have very many chamas, very many, call them small-scale investment groups that actually do, they do the saving and also they do the lending. So you'll find that that is why majority of the people maybe in the rural areas may not prefer these digital money lenders. What I would want to say that digital money lenders, in as much as we say they have made access to credit facilities easier, especially to MSMEs, they have their negative impact. One thing, as we have said, they charge exorbitant interest rates, very high interest rates. And when you consider also the loan limits, the time that it takes to repay the loans, those are factors that hinder even actually their uptake. So what you would say that these digital loans are operating in a free and open market whereby there is legal and policy frameworks. In fact, if we have a legal and policy frameworks that can regulate the interest rate, the loan limit, the time taken, the loan repayment fees that they charge, then we can make these digital money lenders more accessible, more affordable, and they can contribute positively to the economy. As we speak, they have led to the growth of the consumer debt. The consumer debt burden or index has increased because we are having people borrowing mainly for consumption. Because if you are borrowing, let's say 10,000, 20,000, that may not help much, especially if it is in boosting business. Majority of the people who go for these loans are for short term. They are for consumption, meeting the recurrent expenses. So it means these digital money lenders have not positively contributed to the growth of the economy. And therefore, there is a need for policy regulation. Thank you, Simba.
Fantastic. All right, let's get back to Anne as well. And out of that, you will say that majority of the lenders or the respondents who were part of this research did not have a problem with the interest rates charged on these loans. The only problem came about with the length of time and the limit of these loans that were getting awarded to the borrowers. Is that reason enough? And for us to go back and say, maybe even as we think about regulating this, that indeed we support the regulation, but when it comes to the interest rates, maybe leave it for willing buyer, willing seller. Is that what we're saying, Anne?
In a way, yes. People don't have jobs most just because of the COVID. And going to a bank, they'll tell you, we have to say you have to have a guarantor, nini. And it's if I have a mobile phone and I have an app, and I can just go to Tala and borrow 20,000. I don't care about the interest rate. All I care about is, as Chacha has said, I need food, I need to pay my rent, I need all those things. For the current situation, the current economy we're in at now, I will say it's as much as we need the regulation, just buyer, willing seller, but all whoever is borrowing the loan, they need to know what we're getting into. They need to know that even after borrowing that 10,000, maybe I'll be paying an interest of maybe 2,000 per month. They need to know that just before they get into it. And then the problem lies into, as much as I want to pay my bills, as much as I want to eat right now, the problem comes in after, let's say when I default. You'll see most of these people, they're just going to the contacts telling people, oh, Anne has borrowed 10,000 and you need to repay it back, or all those. Just that data privacy is what needs to be looked into more. As of now, if people don't care about the interest rates, that's fine, because you can't force someone to go to a cheaper lending facility if they prefer the more expensive one.
Yes. And just taking on that point for interest rates, could you talk, is it possible, Anne, to talk about regulating without really touching on the interest rates? Is it possible, really, Anne?
No, it's not. It's not possible, because you see, even the regulation, they came into place because they saw these digital lenders are taking advantage of Kenyans and charging high interest rates. They just want to regulate that interest rates. As much as the data privacy is riding along the regulation,
yes,
they need to regulate that interest rate so that they do not advantage of the Kenyans and who are in dire need. But they can't regulate without regulating the interest rates. Okay. They'll have to touch the interest rates.
You gotta start with the interest rates. Chacha, let me also ask you that question. Yes, indeed, the analysts are saying, well, if you regulate them and treat them like banks and the circles in the country, that even that penetration that we're talking about here, that they need to penetrate and get to the rural markets in the country is going to be heavily hampered. Let me put the same question to you, Chacha. Can you talk about regulating them without regulating the interest rates they charge on this borrowing? And what do you think, Chacha, will stand as the biggest challenge to these lenders penetrating to the rural markets?
Yes, thank you, Simba. It's like we are in a catch-22 situation whereby we are torn between regulating them and also regulating interest rates.
Yes.
And on the other hand, how would the regulations, for example, impact on the overall uptake of these loans?
Yes.
So first, let's say we cannot talk of regulation without touching the interest rates. Because if we are talking of digital lenders lending up to the tune of 20% even per month, going to 30%, 40%, that is too high. And in fact, that is why partly the CBK amendment bill of 2021 that was tabled in Parliament actually added a clause giving the Central Bank of Kenya powers to regulate these digital lenders. And the powers here may include regulating the interest rate. Although here we have also to be cognizant the fact that we cannot regulate the interest rates to be similar to those of the mainstream banks. Why? Because digital lenders, they don't have deposits. Actually, they don't have capital reserves that can ensure that they are financially sustainable.
Yes.
Maybe partly that is the reason why they charge very high interest rates. But also we need also to regulate the way they operate, their operations, because you find digital money lenders are a bit unethical. And they do send messages and they do traumatize and they depress the clients, because you find some clients saying that, well, I keep on getting messages, I'm actually listed in the Credit Reference Bureau, and yet maybe I'm making attempts to repay the loans. So this kind of unethical practice, which also brings in the issue of data privacy of information. Because it's like digital money lenders, where they get the information of the client, you wonder, because you find them sending messages to your phone, and yet you wonder, how did they get your phone number, for instance? So the way they operate here also needs to be regulated, Simba. Thank you.
Pretty much. Did I just hear Odhiambo Ramogi join us this morning? If indeed, Odhiambo Ramogi, good morning, sir.
Good morning, Simba. It's a pleasure to be here. I'm sorry I'm late.
It's a pleasure that we have you around. Let me get you into this conversation. Just one question, Odhiambo Ramogi, as we step out of this issue and jump into the next one. I put this question to Anne and Chacha, and they seem to be in agreement that you can't talk about regulating digital lenders in the country without really touching on the interest rates, in the sense of it can never be a willing buyer, willing seller in an unregulated space. You agree, disagree, Odhiambo Ramogi?
I agree. The interest rates are crazy. And it's not just the small players. Fuliza's interest rate is in the regions of 300, 500%. That's just crazy. But at the same time also, I think I might want to add to the conversation that lending has moved to the digital platform.
Yes.
And so mainstream lenders that are properly regulated in terms of interest rates need to consider that. But they also need to, open up the space, because they are used to traditional lending where you go fill up application forms, sign at least 50 times on that form, and then after that you wait for 7 days and then you get your money. These guys, with USSD, you can access 50,000, 100,000, and most of it is going into betting. And so there is need, therefore, to regulate. There is need to provide interest rates, but there's also need to provide credit, accessible credit to the public, using better, better platforms, better approaches by the mainstream lenders.
Yes.
So that then we have access to credit and these guys don't take advantage of the public.
Pretty much. All right, let's move on to the next issue that we have for you this morning. Now, with the cost of living and the inflation rate for August went up to 6.57% compared to 6.55% recorded in July. This is according to the Kenya National Bureau of Statistics data released early this week. KNBS is attributing the rise in the cost of living to the high prices of commodities and food and non-alcoholic beverages 10.67%, transport 7.93%, and housing, water, electricity, gas, and other fuels at 5.07%. Now, the month-to-month food and non-alcoholic drinks index rose by 0.46% between July 2021 and August 2021. Compared to July 2021, prices of cabbages, spinach, and oranges increased 3.74%, 3.06%, and 2.44% respectively, in contrast to prices of potatoes and onions, which dropped by 0.48% and 0.3% respectively. Let's look at where we are. We're going to look at that inflation rate in terms of quarter by quarter analysis. We're looking at it in terms of half year analysis, and we're going to go back to what we have. Richie, could you give us that data this morning in terms of our inflation so we can actually get to look at it as well? Do you have it? Yes, we do. And we're looking at it in terms of quarter one of 2018 up to quarter two of 2018. That's exactly what we're looking at, those 2 quarters from 2018 to 2021. And indeed, you can see that at even quarter two of 2021, we are talking about high rates of that inflation. I mean, across the board, you will see that the only time we were around that area was around February, Q1 of 2020, when we were close, very close indeed, to that 7% safe margin of inflation numbers that we do know is given by the Central Bank of Kenya. All right, now let's come back to this and question whether indeed these are the numbers that we are feeling right now. And let me start from a very basic level. It's within limit. But then you and I will go outside there, will tell people that, well, it's within limit. It's anchored below that 7%, so we're doing fine. But then sometimes you like to feel the heat even when it's at 5, when it's at 4. Can you help somebody listening to you this morning on why we will say it's well anchored below that 7%, but then the heat and the cost of living is a pain?
You see, as much as, yes, we are within the limit of 2.5 to 7.5%, but us as the consumers, we enjoy when the inflation is low because we are paying cheaper things. Like even our disposable income is not reducing in tandem with the inflation. But you see, the major problem is, as much as the consumers want lower inflation, even the suppliers, they can't take on the burden of just afflicting so that you can have a comfortable life. They always pass it down to the consumers, and this is why the cost of living right now is very expensive. Because if you remember, even for the excess duty that was increased, we didn't see Akina Safaricom and Airtel just say, oh, now you just because we love your customers and meaning we'll take it up in our books. They just passed it down to the consumers, and this is just the way of life. As much as we want the cost of living to be low, suppliers and will always pass it down to consumers, and it will always impede our money. Will always, if let's say I'm earning 10,000 and the inflation is at that 6.5%, the amount of money that I will use is less if the inflation was at 4%, and this is just because the suppliers are just passing it down to us, the consumers.
Pretty much. Chacha, let's talk about those micro indicators this morning that are really part of that inflation number. And let's talk about that. They're saying if you look at those two indexes, the food and non-alcoholic beverages, it's at 10.67%, transport 7.93%. When we talk about housing, water, electricity, gas and other fuels, 5.07%. But if you look at those biggest contributors, it is food and non-alcoholic beverages that have pushed it to 10.67%. So, Chacha, it looks as if indeed it's heavily anchored on the food prices in the country.
Yes, when we are talking of the increase in the rate of inflation, for example, here we are saying inflation has decreased from 6.55 to 6.57. That is a positive deviation of 0.02%. And in this case, inflation is actually occurs when there is an increase in the prices of goods and services.
Yes.
That means the cost of living consequently also increases. So in this case, this slight increase in the inflation figure, as you have said, is as a result of those micro indicators, whereby the leading here we have food and beverages maybe at 10.6%. And as Anna said that, the consumers are actually at the tail end and they suffer the effect of this price increase because the manufacturers, what they do when the cost of production of the goods increases, they pass it over to the consumers. And the consumers here are the ordinary Kenyans, maybe you and I. So that's the increase now in the prices here leads to the increase in the rates of inflation. And as a result here, the cost of living increases. So maybe to regulate this, the Central Bank of Kenya has really an Herculean task here. How does it now regulate the inflation and also by extension protect the Kenyan shilling? It is actually by ensuring that the economic environment is quite favorable. It's by ensuring that the industries, the manufacturers here operate in an environment whereby maybe the materials, the raw materials required, maybe the labor here, maybe the oil here, the prices of oil at manageable levels, so that when they produce the goods, they do not necessarily increase the prices because of the increase in the cost of production. So in this case, here, Central Bank of Kenya has to play a big role if we have to control this rate of inflation. However, as it has been said, it is not over 7.7%, but if things go the way they are going, by the end of the year, it will be beyond 7%. And that will have a negative impact on the economy. The common man will continue suffering. Thank you.
Fantastic. I will beg that we take a short break, but once we come back, Odhiambo Ramogi will be getting into that then, because the question is, how effective has been the CBK's monetary policy in controlling inflation? Has it had any impact, if any, indeed, in those numbers? Once we come back here on a Metropole Television, and maybe something that would act as bad news to those numbers, the Meteorological Department is warning that this long period of dry weather in those key areas of the country is bound to continue. In fact, even a warning some pastoralist communities now in the country to destock while their livestock is still alive, or else they'll be running into those losses. Once we come back here on a Metropole Television, my name is Simba Elijah Charles here.